Welcome to the Treasury Update podcast presented by Strategic Treasurer, your source for interesting Treasury news, analysis, and insights in your car, at the gym, or wherever you decide to tune in. On this episode of the podcast, special host Meredith Zonsius talks with Craig Jeffery, managing partner of Strategic Treasurer, on being intentional with technology. As part of the Becoming a Treasurer series, they explore how technology is a key tool in all areas of finance, and Treasury is no exception. Listen in as they explore some perspectives and actions you will want to understand and undertake as you continue your journey to becoming a treasurer. Let's kick it off with what is the purpose of risk management and how does hedging play a part in this?
Risk management and hedging, the process of bringing your exposures in line with your risk appetite. That is, decreasing them into the realm of what you're capable of accepting as a loss or a negative part. Hedging is one way to bring those exposures in line with your risk appetite. Maybe your exposures are too large and you use some type of financial instrument to hedge. And you do that. There's other kinds of hedges and other ways of reducing exposures, but to answer your question about the purpose of risk management, it's bringing your exposures in line with your risk appetite.
Let's break that down a bit. Can you discuss risk appetite? What is that in context?
Yeah, now different people describe risk measures differently. We think of three: risk capacity, risk appetite, and risk tolerance. Risk capacity is what level of risk or what level of loss can you potentially bear, the organization can support. So this is the maximum. Above that, you're illiquid or you've lost too many assets. So that's the maximum amount that a company has the overall capacity to do. Most people then define their risk appetite. This is the level of loss that they're willing to live with. Waking up in the morning, there's a risk. Not waking up, there's a risk. There's risk in life, there's risk in business. A risk appetite is what's your stated level of acceptance of a risk. I'm okay with losing up to 5% of my overseas earnings, or whatever the number is. That's a risk appetite. The risk tolerance is something we bring up because that is a lower level of risk than an appetite. So the biggest risk is risk capacity. Then the risk appetite is what's stated. And then there's a practical level of risk tolerance that's a little bit lower. That's the point where people get really uncomfortable. Even though it hasn't reached their stated risk appetite, people get concerned. You see that all the time in personal investment portfolios. People are like, oh, I'm good with this level of risk. The market moves 10 or 12%. They start pulling things out because their tolerance was really lower than their stated risk appetite. So we think of risk appetite as what is the organization willing to bear as a loss, and that's what we, for simpler terms, that's what we discuss for that. Exposure is the language of hedging. Can you expand on that? Yeah, so when we talk about exposure, so for those in finance and those listening on their way to become a treasurer, if you're in treasury, you're probably familiar with some of this language. If you're really new to the business, then this may be new terms. So exposure is it could be an asset, it could be a liability. It's what you're exposed to movement in interest rates. So you have a floating rate note that can go up and down based upon market conditions. You're exposed to an increase in interest rates. That's your exposure. So you have an IR exposure. You're doing trades in foreign currencies. You got different currency pairs. You're exposed to a negative move in foreign currency pricing. Same thing with commodity price, et cetera. So that's the language of hedging. It's a shorthand way of talking about these different types of risks that we face, and so you define them as an exposure. The exposures can be operational risks as well, and some other concerns that you have. But thinking of it in that manner is one way.
Let's get into some of the concepts or principles. Tell me something that is basic.
Sure. Some basic risk management principles or concepts. Two, I would say, would be diversification and framework to policy. So diversification is this idea of spreading your exposure out, not having all of your eggs in one basket. What that might mean is I've got a bunch of short-term investments. I don't put them all into one counterparty, to UK banks, French banks, US banks, whatever. Maybe I'm spreading them out to multiple banks. Maybe I'm spreading them to different industries, maybe corporates, high tech, et cetera. So I'm diversifying my investments in that case so that if there's a problem with any one of them, it's a smaller percentage of my portfolio. Diversification is one of the most common methods of managing risk, spreading out your eggs. The second is the framework to policy. Everyone talks about risk management policies. What's my interest rate policy, FX exposure policy, commodity price policy? They have different policies that tell you how to operate, who can do what type of reporting exists. But the other concept or principle that is basic, but it's not always done, is this idea of a risk management framework. What is the organization's overall approach to risk? What are those exposures by these big categories? What matters to the organization? How will you generally report, monitor, calibrate these risks across the entire spectrum? And then particularly for Treasury, focused on the financial risks. And so from that framework, you then can move down into the policy documents and write down some of the specifics, the what, the when, and the where. And that's a second key concept that's fundamental, but not always treated so basic in many organizations. It's usually focused on a policy rather than the framework.
Craig, how often should you change your risk framework and policy?
Well, it depends if it needs changing, and I'm not being sarcastic with that, but that's the key determinant whether it should change. But how often should you review them is what will determine if it changes. I recommend looking at the framework every year. That's what we recommend, just to make sure it's updated and it works. Usually the framework won't need changing very often, maybe every 3, 4, 5 years. Policies, some of them are good for a long period of time. So it might be your interest rate policy is perfectly in accord with new developments and changes over time, and you don't need to change it for multiple years. Your investment policy may need to be updated with other asset classes, maybe every year for a while. So you should at least look at them every year. I think that's probably the best answer to that good question you asked.
Excellent. That's good to know. How about some principles?
The first one is the concept of the black swan. Those who have read Nicholas Taleb's book, more than a decade ago, was really popular during the financial crisis. No one in England, for example, thought there was a black swan. They thought swans were white. And then someone brought a swan back from Australia that was black, and that changed how people looked at things because swans were white. You didn't realize that other things could happen. And this is used as a principle, as a story to say that certain things can happen that we don't expect. Interest rates can't go negative on bonds. Well, they have. They happened in Japan and in other places. This idea that we might not expect it, that doesn't mean it won't happen. And so I guess we oftentimes see these times of normalcy and then periods of volatility, moderate to great volatility. You can see some of that in examples of, you've got these tsunami stones in Japan. They're placed at all these points up on the hill that said, don't build below this point because the water's reached this level. And so we forget about that when there's no tsunami. We're in a period of stability. We build on the floodplains. We build next to, whatever disastrous areas because we think things are going to be normal, or we think the average is fine. And then there's volatility. And so this idea, this concept of there are things that are going to happen that you don't expect, which means you need to have some sort of margin and flexibility and ability to respond. So that's one concept. A second one would be using the expected value can make you lose money or lose your business. There's that concept of, there's the normal bell-shaped curve. It moves up and goes across, and there's the 5% on the left, the 95% on the right. Its expected value is in the middle. It's the peak, and it's a nice, perfect-shaped bell curve. And it's that concept, I think I've mentioned this before, is if you You roll 2 dice. What's the expected value? It's 7. You got 1 through 6. The average roll is going to be 3.5 on a die. You roll 2. The average roll is a 7, so the expected value is a 7. But as you go out the curve, you can get a 2, you can get a 12, you can get a 3 or an 11. But most likely, or more likely, you're going to get a 5, 6, 7, 8, or 9. But that doesn't mean those other ones don't occur. And so if you just think of, I'm solving for my outcomes to a single value, I have more volatility than I expect. And since I have more volatility than I expect, I can be surprised. And when I'm surprised, I can lose money. I can have to unwind things very rapidly. That can be costly. I can run out of money and then have to borrow at the last minute. So the expected value, just looking at things from an expected value as opposed to a confidence level, can make you lose money. So think about the range of outcomes over time.
Do you gamble, Craig?
I don't. If I ever get the urge, I just take $20, throw it in the toilet, and flush it. The third area is we use the phrase, don't cheer for your hedges, or normally don't cheer for your hedges. David Stowe, who used to work at Strategic Treasure, and I had many, many conversations about hedging, the principles of risk management, and we would say, hey, let's not cheer for our hedges. And why was that? You think about what level of cover you have on your hedges. And so, let's say you're exposed to the purchase price of fuel oil. So you're exposed to the purchase price of fuel oil. And let's say you say, we hedge 75% of it. Well, your hedge maybe protects you against a certain movement. And so if your underlying asset loses money, your hedge makes money. And if your underlying asset makes money, your hedge loses money. That's typically how you're setting up your hedge. So one offsets the other. Same thing with interest rates. If I had a floating and I went to fixed on my interest rates, I wanted to lock in my interest rate exposure so it's flat. If one moves up, the other moves down. Hopefully they're matched fairly well. But in many cases, you're hedging some percentage, 50%, 60%, 70%. So if your underlying exposure makes money, your hedge would lose money. But because your underlying exposure is usually 100%, and let's say your hedge is 75%, which would you want to make more money? Typically, you'd prefer that your underlying exposure does better and that your hedge would lose money in terms of that type of concept. You don't want your hedge to make money by itself because your underlying exposure would lose money and typically lose more money than that. And so if you're going to do any cheering, it should be for your underlying exposure typically. But you shouldn't be doing any cheering because the reason you have your hedge is that you're trying to bring your exposure in line with your risk appetite. And you're fine if it's accomplishing that. It's not that this made money or that made money. And I mention that because you should say, what puts us in a better position? We protected our risk and we protected our exposure from greater volatility. This helped us with our underlying assets, our cash flow, our income, etc. So it's not to think of hedges speculatively, which is why you would cheer. It's to think of them in the normal business. It's how did I bring my exposures in line with my risk appetite? Did my hedges accomplish what the purpose was? And so you can run into those situations where someone says, wow, we lost money on those hedges. Yeah, we did if we take it in isolation. But we would have done better if we didn't buy those hedges. Done better how? In this one instance? Yes, if we were speculators, if we were a hedge fund and we're taking those positions, that would be fine, but that's not what we're doing. We're trying to reduce our volatility, and we've done that. So we can be very happy with what we've accomplished.
What are other principles or examples that you can share?
Well, just some guidance. One would be you must communicate to the non-finance people. The communication is a process and it's continual. And it's like that example I just shared about, did our hedging, for example, accomplish what our purpose was? Here's what we're doing. Here's why. Here's the performance of the hedges and the underlying assets. And this met our objectives, to make sure that the objectives are in front of people. So that's another one. Another way of looking at it, or some of the concepts are, calibration in the envelope, I'll call it. Ben Campbell of Capital Advisors Groups and I've had discussions over time. We talked about the policy envelope, and the policy might be duration. The left to right might be how long you hold certain counterparties or instruments. So there might be a duration aspect. And then there might be the vertical part might be, what types of asset classes or counterparties. And so the concept is that you can move around within the policy envelope. Maybe things are getting a little rough, and so you pull in your exposure to European banks. You extend out a little bit to pharmacy or whatever it is that you're doing in your investment portfolio. But your envelope, your policy envelope, is where you can operate, and you can make decisions within that envelope because those are your guidelines. Those are the edges. So when things get a little more concerned, you say, I want to shorten the duration, for example. And so that's one aspect of using the envelope. You're not taking a position per se, but you're making adjustments within this guided structure of the envelope that's really from the policy, which cascades down from the framework. So you're moving within the bounds of what you have. The other part about calibration in the envelope is that is how you can move within the envelope, right? You've got these other decisions you've made from a policy level. You're either in agreement with the policy or you're in violation of the policy. But your calibration might be every risk or every exposure is not the same. And so you might need to calibrate within the envelope. If things start to seem to be a little more risky, though they're not showing up in our SRO ratings like Fitch or Moody's or S&Ps, you can still pull back or make some adjustments within those. And the other aspect of calibration in the envelope, or just calibration, is that every risk or exposure is not the same. $100 million of exposure to the largest trillion-dollar bank is not necessarily the same as $100 million exposure to a regional bank. So there's some way of making sure you calibrate those exposures to make them equivalent. So there's some type of risk factor, and whether you use credit default swaps, other rating agencies, et cetera, there's ways of calibrating the risk so you know what's a bigger issue, right? What's more significant or not. The other thing in terms of a concept is that you can be formal and diligent with data and monitor things electronically, but we do need to note changes in sentiment, and informal networks matter in this. So as you talk to peers, you talk to your bankers, consultants, it's more than just fact-based ratings. If you see a lot of people getting concerned about a particular counterparty in times of trouble, they may be giving or getting signals to move out. That doesn't mean you need to move out too, but you don't want to dismiss that noise in a cavalier manner. And you can think of examples. I have one in my book about a certain public entity that was buying into one that was pouring multiple tens of millions of dollars into an organization that was going to be illiquid. And they were moving in while everyone else was moving out. So having some type of informal network and paying attention to the noise of the herd, not necessarily moving with them, but noting it, not ignoring that, is some good advice.
This is all great information. Craig, can you share a little bit, you mentioned your book. If some of our listeners would like to get a copy, how would they go about doing that?
Well, I don't mean to make this a pitch, but you can go to wherever you buy books, digital or otherwise, and you can type in The Strategic Treasurer, A Partnership for Corporate Growth. It's by John Wiley & Sons, and you can get it. You can get it that way.
Great. So, any final thoughts?
Just remember that you need to understand your organization's exposures, and understanding those risks is really vital for anyone senior in Treasury. Not just knowing that they're risk, but understanding those and what impacts those is vital. You need to have some facility with that. That requires work. Second is those exposures need to be calibrated so that you know what are the bigger issues. And you got to watch out for the alligator closest to the boat, which we obviously took it to the extreme. Is it facing the boat? Is it heading away? How big is it? So knowing what those exposures are is important because we do have limited bandwidth. And so calibrating those is important. Third is pay attention to data, sentiment, and actions. Calibrate those exposures and pay attention to the calibration method you're using. Look at what others are doing, that example of your informal networks. And then the final one for this podcast is be ready to respond. And how do you respond when things change and change rapidly? That requires asking some questions. What slows you from being able to respond rapidly? What will make you more nimble? What will allow you to detect things more readily? And what are some of your plans that you have ready in case there's a problem? So knowing your risks, understanding them, how you can respond can save you time when time truly matters the most.
You've reached the end of another episode of the Treasury Update podcast. Be sure to follow Strategic Treasurer on LinkedIn. Just search for Strategic Treasurer. This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.